Okay, we'll talk about merger and acquisition here. So, the first step here is to understand how to classify a merger and acquisition activity. Now, many companies might come together, they might form an integration, or many different business activities can also come together and form an integration, and these gives various forms of these integrations and these mergers. So these forms of integration, and we have got two types of forms of integration and around three types of merger. So the two types of forms of integration is a statuary merger. The acquiring company acquires targets, assets and liabilities. As a result, the target company ceases to exist. Note that in a statuary merger, the target company is usually smaller than the purchaser, but this is not always the case. Whereas in a subsidiary merger, the target companies become a subsidiary of the purchaser. Most subsidiary merger typically occur when target is well-known brand, like a Procter and Gamble buying Gillette. So with consolidation, both companies cease to exist in their prior form. They become together and form a new company. Consolidation occurs in merger when both companies are of similar size. Whereas we can also classify everything into the types of merger, where it could be a horizontal merger or a vertical merger. Horizontal merger, where two business in the same industries may often be competitors and they merge, like two companies selling some food item merge. And a vertical merger is when a company seeks to move up and down in the supply chain. So if you are making an ice cream and you buy a restaurant or something like that, this is a forward integration. Likewise, there could be a backward integration. Then there could be also something called the conglomerate merger, where two companies operate in completely separate industries, but this is less common. Now there is something called the bootstrapping effect, which becomes very important. Now in the bootstrapping, your EPS increases because you buy some company that is good at turning around things. So bootstrapping is a way of packaging the combined earning from two companies after the merger, so that the merger generates an increased EPS. Why this would happen? Because the price that you pay to get this company is such that your EPS increase. So bootstrapping occurs when high PE company acquires a low PE company in a stock transaction. Post merger, the earnings of the combined are simply the sum of respective earnings prior to merger. However, purchasing a firm with low PE price to earning a company is essentially exchanging higher price shares for lower price share. As a result, the number of shares outstanding would increase, but the ratio would be less than 1:1. When we compute the EPS for a combined, the numerator total earning is the sum of combined firms, is less than the sum of combined firms. The result is higher EPS even when merger creates no synergetic value. So the EPS increases. Something that is very important that I want to point here is that the EPS might increase, but your price to earning multiple might shift. Ideally, you should take a weighted price to earning multiple, so that your stock price remains same, because you cannot do something in the stock price arena. You cannot just buy any company and increase your stock price. But if you take the stock price of either the acquirer or the company that you are acquiring, then things become tricky, and then the stock prices could move ahead. So if you take the price to earning ratio of either one, or if you take a wrong weighted average, then you might be thinking in terms of stock prices. So a weighted average PE should be taken, but if you assume that the multiple that you are going to be rewarded is the multiple of the bigger company, then you have to be careful about that. So that was about a bootstrapping. Now there could be a stock repurchase, asset repurchase, and many reasons of targeting. Now I'll talk about a few interesting terms here that are often seen and that becomes important. So those terms, and you can often get some questions on these terms as well in the exams. So there are pre-offer defense mechanism, and there could be post-offer defense mechanism, and this defense mechanism is to avoid the merger. So these defense mechanism are to resist a hostile takeover when somebody tries to take over your company. Now, whether if that takeover is good or bad is a subjective thing, but sometimes the management does not want anybody to take you over, even if you get a good price out of that. So even if you get 30% increase on your stock price right away in the next day, but you don't want to do that. Now, as a business case, you would ideally like to do that because you can invest that money somewhere else and get the percent and get out of the system, but it all depends. So there is poison pill. It is an extremely effective anti-takeover defense where many legal battles in infancy. The poison pill gives current shareholder the right to purchase additional stock of at extremely attractive prices at discount to market value, which causes dilution and effective increase of cost to potential acquirer. The poison are triggered by shareholder equity exceeds threshold of less than 10. So specific poison pills are flip-in pill, where the target company shareholder has the right to buy share at a discount, and a flip-over pill, where the target shareholders have the right to buy acquirer's share at a discount. In case of friendly merger, most poison pills give board of direct right to redeem the prior of the trigger event. So this is like the reason why this is poison, because this will cause a dilution, which is very bad for you. Then we have a poison put. The anti-makeover defense is different from the other as it focuses on bondholders. This gives bondholders the option to demand immediate repayment of their bonds if there is a hostile takeover. So that is poison put. If you remember the put option of the bond, this is the same thing. Now, restricting takeover laws, companies national state incorporate a specific states their rules apply. Some states are more target friendly when other comes rules protect against hostile takeover. Companies they want to avoid hostile may seek incorporate the state and strict anti-lock takeover. So Ohio and Pennsylvania will considered to provide target companies with most protection. Then you have staggered board, restricting voting rights, supermajority voting, fair price amendation, golden parachute. Golden parachute are compensation agreement between target and CM that gives manager liquidator cash if they leave the target company after the merger. In practice, the payout to mergers are not being enough to small, but they are target concerned about losing their job. So this was the pre-offer. The post-offer could be just say no defense, litigation. The basic idea is to file a litigation, the acquire expense and time consuming. The typical process to attack the merger, antitrust ground for some violation of securities law. The courts may disallow the merger and provide a temporary injunction delaying merger, giving manager time to load up the defense or seek friendly offer from a white knight. Then you have green mail. Green mail is a payoff to potential acquirer and the termination of the green mail is agreement allows to repurchase its share. The agreement is usually accompanied by second agreement that will not make another hostile takeover. Green mail was usually popular in 1980s, but it has been rarely used in 1996. Changing taxation law added 50% tax profit by acquired through green mail. Share repurchase, leverage recapitalization, crown jewel defense. After hostile takeover, a company decide to sell subsidiary major the third party. If the hostile views this asset as a deal, crown jewel, then it by abundant takeover. So if they're looking for a particular gel in your company, just get rid of them. Pac-Man defense. In the video game Pac-Man, electronic ghost would try to catch the main character, but after eating a pill, Pac-Man would turn around and start eating the ghost. The analogy applies here. After hostile takeover, the target defenders are making out to acquire the acquirer. In this Pac-Man defense, Larry uses the mean of small company would have larger company. So that is Pac-Man defense. White Knight defense is a friendly third party that comes to rescue the target. That will use a third party or good strategic fit with the hostile takeover. In many cases, the White Knight defense can start bidding a war between hostile and the third party, resulting in a target receiving a very good price. But whoever buys the thing is expensive, so this is called the winner's curse. Then white square defense. In the medieval times, square was a junior knight. In today, the square defense means target seeker friendly that buys a minority stake without buying the entire. This idea is for minority stake big enough to block the hostile takeover. So white squirrel and white knight, you get a third party to save yourself. So that was the defense mechanism that you are going to often see. The other part here is to value the merger and acquisition based on a lot many things and find out what's actually going to happen.